Good evening, everyone, and welcome to yet another webinar on very important topic, which is expenditure and exemptions, which are allowable and not allowed under the UAE's corporate tax regime. Today, I have with me my colleagues Kinjal and Karishma, who will dwell into this topic in the next few slides. But before that, I will be covering the normal rituals, talking about the team. So, if we can move ahead on the slides. Yeah, so anything that we are talking about is our personal opinion as per the law readings and as a firm opinion we have decided. Whatever we'll be covering will be as per MICS team's own comments. I hope that we all enjoy this interactive session. As seen, our tax team has been doing a lot of webinars and events and even sessions for training the corporate tax team or the finance team for the clients, which is very important because a lot of people have to go through this change that earlier UAE did not witness. UAE couldn't manage to maintain the books of accounts, but now with the introduction of UAE corporate tax, this is a paramount, and that is why this training is very important. We have done sessions for our partners, Rakesh. We have been constantly doing sessions for Rackbank and obviously doing webinars and seminars at a lot of places, including ICI, Abu Dhabi, and Dubai chapters. Moving ahead, we have been always been proactive in writing a lot of articles and creating simplified videos for everyone to understand. You can follow us on YouTube and you can follow the Khalid Times paper every week where one of the topics of the article of UAE corporate tax is getting covered, and we are trying to simplify it as much as possible, from normal deductions to normal exemptions to corporate tax registrations, then foundations, which is a very important topic, BEPS, Pillar 2 provisions that are going to happen for large entities because we may not be eligible for 9%, then we'll have to calculate at 15%. International transactions, including transfer pricing, as well as international tax structurings, because a lot of entities have global presence. So, place of effective management is also playing a lot of roles, and all of these we are trying to simplify. And Khalid's Times has been covering us since a long, long time. Again, today what we are going to cover is simple but very, very important. As I said, UAE is going through this change, and it is important to understand what will be your taxable income, what are the expenditures and exemptions that is allowable under the Act, and what are not allowed. Also, to understand whether capital as well as revenue expenditures, what are the kinds, and what revenue expenditure is allowed fully, what is not allowed at all, what is allowed 50%. And then there are thin capitalization rules, interest exemptions, which is capped, very important participation exemption for all those foreign entities, understanding the foreign PE exemption. So these are the topics that we are going to cover. I will hand over to Kinjal to take it ahead and cover very briefly on the exemptions and the expenditures that are allowable and not allowable. Over to you, Kinjal. Kinjal, you're on mute.
Thank you so much, Prateek, for this quick introduction. As rightly said by him, it is very important today to understand what expenses can we claim, what is the portion of taxable income, and therefore today we are here to touch upon very important topic for all of you. So everyone is now aware that 9% CT is applicable to entities as well as individuals who are conducting business through licenses. But what we are going to cover today is what is subject to that 9% CT, what adjustments are required to that taxable income. Two most important things, which would be the deductions not allowable for taxable purposes and the exempt income and the conditions which one needs to fulfill so that the exempt income is not taxable. Can you switch on the next slide, Karishma? What is subject to 9% tax? Now, a taxable a taxable person's taxable income is subject to 9% CT. And for arriving at that taxable income, what needs to be done is certain adjustments need to be made to the accounting profit as per your profit and loss account, which means the starting point of deriving your taxable income is the accounting profits as per profit and loss account, which is your profit and loss account as per your financial statements, which would have been made in compliance with the RFRS. Now, to arrive at that to derive that accounting profit, there must be a top line, which is the revenue, and certain list of expenses must have been deducted from that top line to arrive at the accounting profit. However, for the purpose of corporate tax, all the expenses which are computed, which form a part of your financial statements, are not allowed. Some expenses are deductible, some are not deductible, and we are going to discuss this rule in detail. Next slide, Krish. Yes. So, for the purpose of simplicity, we have bifurcated this into three segments. One is the general rule. Now, as per this general rule, there are two conditions which one needs to follow. Every line item of your expenditure PNL, which is incurred wholly and exclusively for the purpose of business, and which is not capital in nature, would be deductible. And this would be deductible 100% rate. However, there are certain specific disallowances which are provided in the law, which would not be deductible at all, and no deduction would be available for the same. And in the third limb, there are certain special provisions which are there for entertainment expenditure as well as the interest expenditure. Now, what is wholly and exclusively for the purpose of business? Here, what is important is to note down the purpose of the expenditure, which can again be divided into three parts. One is wholly and exclusively for the purpose of the business. Second would be which is partly for the purpose of business and partly for some other purposes. And third would be which is not for the purpose of business. So we are very clear about the first and the third one. If it is wholly and exclusively for the purpose of the business, it would be allowable. And if it is not for the purpose of business at all, it would be disallowable. Now, what needs contemplation is an expenditure which is incurred partly for the purpose of business and partly for some other purpose. In such cases, we will have to apportion the expense which is only for the purpose of business, and only that much expense would be deductible. For example, if there's an employee who is drawing salary from the company, and that employee is utilized for business purposes as well as for non-business personal purposes. In that case, if supposingly that employee is working from 9 to 4 for business related work, and post 4 to 6 he is working for personal purposes, in that case it is easily identifiable, and you can split the expense between what is for business and what is not for business. However, if that employee is working on as and when basis, in that case a portion would have to be made on fair and reasonable basis. Now, what is this fair and reasonable is again defined in the law, and the law has clarified with what is fair and reasonable depends on the facts and circumstances. Then it should accurately reflect the activity which that employee is performing. And two most important conditions are that it should not be burdensome or complex for the taxpayer to compute, and in case your file is picked up for audit or review, it should be easily understandable by the FTA authorities. Coming on to the second condition, which is your capital expenditure. Yeah. So capital expenditure. Now this is very simple in terms of understanding what is capital expenditure, versus what is revenue expenditure. Something which gives an enduring or long-term benefit to the business. It increases the earning capacity of the business, and is generally it is a significant one-time cost. Such kind of expenses are capital in nature, versus something which supports your day-to-day business operations, don't increase or partially increase your earning capacity, and a routine regular cost are revenue expenditure. To take a very simple example, if a new machine is acquired for the purpose of business, in that case that machine is going to give a long-term business benefit. It would definitely increase your earning capacity, and it is a significant one-time cost, so that would be a capital expenditure. versus the regular wear and tear and maintenance of the machine, that would be a revenue expenditure. Now, the capital expenditure, although it is not deductible in year one, it is deductible in the form of depreciation and amortization over a period of years, versus the revenue expenditure, which is wholly deducted, subject to the general rule, of course, would be wholly deductible in the same year in which it is incurred. Next slide, please. To give a very simple example, if if company A has purchased a land and the purchase cost of the same is 3 million, and also there are some fees which are paid to the real estate agent of 0.09 million. In that case, the total cost of the land becomes to 3.09 million. Now, when the land is sold in year 4, in that case, if it is sold at 3.3 million, then your 3.3 million minus your 3.09 million, this includes the fees paid to real estate agents, because as per IFRS, it was capitalized in the books. In that case, your taxable gain would only be 0.021 million. Next slide. Yeah. So this covers the first bit of it, which is the expenditure which falls under the general rule and which are allowable up to 100%. Now comes the second limb, which is expenditure which are specifically disallowed. That means no zero deduction can be claimed of these expenditure. Now, the first one in this is deriving any exempt income. If any expenditure is incurred in deriving any exempt income, what is exempt income? We will be covering in the later part of the presentation. But if any expenditure is towards deriving any exempt income, that would not be allowed. If there are any losses which are incurred which are not connected with the business, supposingly there's a car which is used for personal purposes and that car is lost or theft. In that case, that loss does not relate to the business and would not be allowed. Further, if any donations, grants, gifts are given to non-qualifying public benefit entity. Now, what are these non-qualifying public benefit entities? These are entities which obtain approval from the FTA authorities and are functioning towards recreational towards these are the entities which are functioning towards regional boosting regional cultural activities in the UAE. So if any donation, grants, gifts are given to any non-QBPE, then the same would not be allowed. Any fines, penalties which are paid, which are breach of law, would not be allowed. Versus if supposingly if any fines or penalties are paid for a breach of contract, supposingly there was a contract which your company must have entered with the vendor and which could not be fulfilled, and there is a fine of AED 10,000 dirhams which you would have paid for it, that would be allowed. But if any fine relates to breach of law, that would not be allowed. Any bribes or illegal payments are not allowed. Now, dividend profit distributions are again line items which are after the profit, which are subject to tax. So generally, these are not allowed. But if you have charged dividend or profit attributions above your profit line, then the same should also not be allowed and should be added back. Any drawings by sole proprietor, partner, since all these are personal in nature, they are not allowed. Now, the very important thing is any corporate tax which is paid in UAE or any corporate tax which is imposed outside UAE, maybe in the form of foreign taxes, withholding taxes, or direct payments, the same is not allowed. However, one can evaluate whether foreign tax credit can be available of the taxes which are paid outside. Any recoverable input VAT is not allowed. Any VAT which is irrecoverable, that would be still allowed, but if any recoverable input VAT would not be allowed. Then, if one is entering into transactions with related parties, then one has to make sure that the same are entered at ALP. If the same are not entered at arm's length price, then the same would not be allowed. Just to give you all an example, if I am deriving any services from my related party, and that services and the cost of the services which the related party has charged me is AED 10,000 dirhams. However, if I go to avail the same service in the market, the same would be available for AED 8,000 dirhams. Then the excess AED 2,000 dirhams would not be allowed. And FTA would time to time specify the expenditures which would be included in the list of expenditures specifically disallowed. Next slide. Just to give you a simple example to cover what is expenditure in earning an exempt income. Supposingly, company A pays salary to an employee, and company A is deriving income only from dividend, which is also from another UAE entity, which is not chargeable to tax under UAE. In that case, the salary which is paid to the employee would be a non-deductible expense. However, if company A is deriving dividend income plus some other taxable income, in that case, the salary would be partially deductible. And again, we will go to the law of apportionment, in which case, only the salary which is apportioned to other taxable income would be allowed. Now, how can you calculate this apportioned income? Maybe basis the timesheet which the employees maintain, the time logs. You'll have to segregate the timing which is earned in, which is spent in earning the dividend income versus which is spent in earning the other taxable income. Yeah, now there are certain special provisions with respect to managerial remuneration. So, as everyone would be aware, that remuneration to KMPs are considered as connected person for the company, and accordingly, in case of a company, remuneration would be allowable, but only if it is at ALP. And for the case of sole establishment or proprietorship, which are generally regarded as pass through entities, they do not have any separate legal identity. In such cases, the remunerations are not deductible or not allowable. Yeah. So this, with this, we cover the second limb of the specific provisions, which were the expenses which are not allowable at all. Going to the third limb would cover special provisions which relating to entertainment expenditure as well as interest expenditure. So that it is very common for a business to incur certain entertainment expenditures for the purpose of entertaining their clients, partners, suppliers, shareholders. So these all expenses are very common. However, these expenses do have a personal element which is incorporated in them. And therefore, FTA has already restricted the allowability of this expenses to 50%. This overall entertainment expenditure which we claim would again be subject to the general rule. The general rule which states that the expenditure should be incurred wholly and exclusively for the purpose of the business, as well as it should not be capital in nature. Versus if the same entertainment expenditure is for the purpose of employees, then the same like staff welfare expenditure, in that case 100% reduction would be available subject to general rule. Just to simplify this with an example, if company A is organizing golf for clients and spending 10,000 dirhams, in that case, this is for the purpose of business, and accordingly, it would be restricted to 85,000 because there's a 50% restriction. Versus if company A is organizing golf for clients as well as families and it spends 80, 10,000, which where we can apportion that 25% audience is family and 75% audience is client. In that case, only 50% of 7,500 would be allowable as an expenditure and the balance would not be allowable. Coming to the last limb, which is interest deduction. Now, generally, where a parent entity wants to fund its foreign subsidiary, then two sources are available. It is either by the way of equity or it is either by the way of debt. But there's an advantage if the funds are supplied by the way of debt, since interest is claimable as an expenditure versus dividend, which is not claimable. Also, it would give an added advantage if the foreign subsidiary is in a high tax jurisdiction and the parent entity is in a low tax jurisdiction, as there can be an instance of profit shifting. Now, this was recognized by OECD, and there were certain provisions which were instituted known as thin capitalization rules to restrict the deductibility of interest above a certain debt level. Now typically these provisions were in relation to when loan is given by one party to another related party. However, the UACT law has kept these provisions broad, and there is no such restriction of that the loan is taken only from related party, and these provisions apply to all. So let's study what these provisions are in detail. So, according to these provisions, the interest expenditure which is claimed, if it is more than 12 million dirhams, then it would be restricted to 30% of your earnings before interest, tax, depreciation, and amortization. Which means that first we'll have to see if the interest is more than 80 12 million dirhams or less than 80 12 million dirhams. In a case where it is more than 12 million dirhams, then 30% of your earnings before interest, tax, depreciation, and amortization will have to be calculated. And the interest deduction would only be limited up to the 30%. The excess interest would be disallowed. However, there are provisions that you can carry forward that interest up to 10 subsequent periods. And of course, there's no treatment in the UACT law if a loan is granted from a related party or an unrelated person. However, since the purpose of the provision was to curb the provisions which were misutilized by the companies and the groups, there are specific exclusions which are there to which these provisions would not apply. The exclusions are to bank, to insurance providers, and to natural persons who are generally into carrying on such businesses of giving loan. We would explain this further by way of an example. So supposingly in year one, the net interest expenditure is 80 million dirhams and the EBITDA is 200 million dirhams. Then since the interest expenditure is more than 12 million, we will have to restrict it to 30% of the EBITDA, which would be 60 million dirhams. Higher of the two, that is 12 million and 60 million dirhams, 60 million dirhams would the deductible expenditure would have to be restricted to 60 million dirhams, and the balance 20 million dirhams would be disallowed. However, it can be carried forward up to 10 subsequent years. Now, in the next year, what would be my net interest expenditure would be the 9 million from the year two, as well as the 20 million which is carry forward from the previous year, making my net interest expenditure to 29 million dirhams. Now, in the year two, where my EBITDA is 50 million dirhams, what I'll have to limit it to is 15 million dirhams, which is the 30% of the EBITDA. And finally, my deductible expenditure would be 15 million dirhams, which would be 30% of the EBITDA. And the carry forward interest, which I have carried forward from the previous year, I can utilize it in my current year. And my balance to be carried forward for future years would only be 14 million dirhams, which means that 9 million dirhams of this year, as well as 6 million dirhams from the previous year, I could carry forward and I could utilize it against my balance of 15 million dirhams. Now, there are certain other considerations which are also involved in this interest deduction clauses. What about the loan agreements which were entered before the CT law was implemented? So, for such loan agreements, there is a grandfathering provision in the law, and the thin capitalization rules would not apply to any loan agreements which were entered prior to 9 December 2022. Now, one situation which also arises is, what if I take a loan from my related party and can I use that interest? Is that interest deductible? In that case, what will have to be seen is what is the end use of the loans taken from related party. If I'm taking a loan from a related party and utilizing it for dividend, profit distribution, capital contribution, then such interest would be disallowable. However, there is an exception to the same, that if it is proved that the purpose of this arrangement was not to gain any corporate tax advantage, then the interest can be deductible. Also, when the related party is subject to tax at a rate of more than 9%, then it will be automatically deemed that there is no corporate tax advantage. So, with this, we cover largely all the provisions related to deductions. And now I hand over to my colleague Karishma, who would take ahead the exempt income bit. Thank you.
Thank you so much, Kinjal. I hope now you must be clear about what expenses would be allowed or would not be allowed while calculating your taxable income. The another important and interesting topic which everyone is concerned about is, what about my income, which would be exempt income. So majority, everyone would be aware that the majority income that would be exempt in your hands is with respect to the dividends or the capital gains that you will be deriving. Now, to exempt that income as well, there are certain conditions which needs to be fulfilled. Then and then only your dividend income or your other profit distribution as well as the capital gain would be exempt. So before getting into the details of how this dividend and other profit distribution would be exempt, first let me cover what are the broad levels of income that would be exempt in your hands. Very first, if you are receiving dividends or other profit distributions from a resident juridical person. So if you are a resident juridical person and you are receiving dividends and other profit distributions from another resident company, maybe it in a free zone, maybe in a mainland, wheresoever it is located, but within UAE, then any dividend and other profits which may be distributed by such company would be straightforward exempted in your hands. The another important exempt income is whenever you are receiving any dividends or other profit distribution, but in this case, it is received from a foreign juridical person. That would also be exempt in your hands, but the only conditions that you need to fulfill in that case is with respect to the participation interest. Now, what is participation interest? That will be explained later on after the slides. Also, any other income that that you will earn from the participation interest would also be exempt. That also will be covered later in the latter slides. And if you are earning any income from your foreign permanent establishment, even those would be exempt. Now, it may happen that you are having a holding company into UAE and you have your permanent establishment, say your branches or your associate companies outside the UAE. Because of the foreign permanent establishment, they may be taxed in that another jurisdiction as well. So to curb and to avoid double taxation on such entities, there is an exempt income allowance that is being given with respect to your foreign Ps. And lastly, if you are a non-resident person and you're deriving income with respect to operating an aircraft or ships in an international transportation, even that income would be exempt income. Now let's delve one by one into each category of this exempt income and how it would be an exempt income in your hands. So very first, coming to the very simple, which is with respect to the domestic dividend income. So the case is very simple. Now, if you are a company and you have been distributing the dividends, say it is being received either by me, a natural person, or it is received by MICS, say a juridical person. What would be the taxability? If it is received by me, a natural person, if it is received in the course, firstly, there are two conditions that very first needs to be checked. Is it received in the course of business or business activities in the UAE? If yes, is the revenue that I'm deriving from this dividend income is exceeding 1 million dirhams into my Gregorian calendar year, that is during the period of Jan to December. If both these conditions are fulfilled, if yes, then it is treated as my personal investment income and by default it is not a taxable income under the UACT. However, even if it is received in the course of my business or business activities and it is exceeding 1 million dirhams, if I'm receiving dividend income, in that case, it would be an exempt income. So in both the cases, it is a win-win situation. If it is received in the business activity and exceeding 1 million, but being my personal investment income, it won't be taxable. Even though it is less than that, but being an exempt income, it won't be taxable in my hands. Similarly, with respect to juridical person. Now, supposingly, if MICS has received any income from any dividend income with respect to investment in any another companies, and if this is being received from another juridical person, say there is another company into the UAE and that company is paying me such dividend, or it is received from a non-resident person but which is having the permanent establishment in the UAE, then that income would also be exempt and it would not be taxable. So to simplify it in a very simple language, domestic dividend income received by a natural person or by another juridical person straight away would be exempt income without any further conditions. But the complexities come when you are receiving any dividend income from a foreign investment or from a foreign juridical person. Now, before getting into the complexities of how this foreign dividend would be exempt in your hands, there is a concept called as a participation exemption. Now, why UAE has introduced this participation exemption? Suppose, say, if there is a company in USA, it has earned a profit of 100,000 USD. It has also paid taxes in the USA, and now it is distributing the dividend. Now UAE company, being one of the shareholder of these companies, is receiving the dividend, say of $1,000. Now this $1,000, when company B, which is located in UAE, is received in his hands, it will be treated as a taxable income, and being a taxable income, it will also be liable to pay taxes on such dividend income received. Now, to avoid this double taxation on this $1,000 distribution of dividends, as it will be taxed in both the countries, USA as well as UAE, therefore, there was a concept which was introduced, that is the participation exemption. So, to avoid this double taxation, there is this participation exemption that is being introduced. Now, what is participation exemption? So the law has divided and law has simplified it, kept it very clear. Whenever a company is making any investment with the help with the intention of a long-term interest into that company, it is known as participation. And whenever you are having or whenever you are doing such investment, you should fulfill these 6 conditions. The moment these 6 conditions are fulfilled as a company or as a juridical person with respect to your investment into the company in which you are making the investment, any dividend income or any other profit distribution that this foreign juridical person would be doing would be exempt in your hands. Now we will delve into all these 6 conditions one by one, how you can fulfill these conditions and what would be the treatment given if you fulfill all these conditions. So coming to the important conditions, that is first condition. So before getting into the condition, just to summarize it in a very simple language, if the participating interest conditions as explained as the 6 conditions shown in the earlier slide, if those are being fulfilled, if it is being received by a foreign participation, as I said, if it is received from a foreign company, then that income, if it is with the respect of dividends or other profit distributions, it would be treated as an exempt income. Any other income that is received from your foreign participation, say if you are providing any services or you're receiving any interest on loan that was being provided to this foreign company, that would be taxable income. Other than that, all the income that you're receiving from this participation conditions being fulfilled, it would be an exempt income. The similar concept would apply if also you are receiving the capital gains. It may happen that the investment you have made with the intention of long-term investment, but at a certain point of time you're disposing of or you're selling off that investment which was made into the domestic company. Even the capital gain that will be derived by such investment from this foreign participation or even from the domestic participation would not be taxable and would be an exempt income. So for that, the only condition is you need to fulfill these 6 conditions. So the capital gains or even from the foreign exchange gain or loss, or if there is any impairment into those investment, even those gains and losses would be treated as an exempt income. So I hope this simplifies that if the conditions are fulfilled, your capital gains, your dividend income, your foreign exchange gain or loss, and even your impairment gains or loss from domestic as well as foreign participation would be exempt. Any other income that you are receiving apart from this dividends and the profit distributions would be treated as a taxable income. Now let's get into these conditions, how we would be treated to be satisfying these conditions. The very first and important condition is that you should have a minimum ownership interest. Now, what do you mean by ownership interest? When I say that a company, UAE company, should have a minimum ownership in the foreign company, what are these ownership interests? So you may have the investment in the foreign company in the form of ordinary shares, in the form of preference shares, redeemable shares. Even Islamic financial instruments or a combination of those arrangements would be treated as a minimum ownership. Only the options are right to use or right to buy or right to sell. If you are having an investment into a foreign company under the options method, only that would not be considered as having a minimum ownership into the foreign company. Apart from that, whatsoever any equity or any other kind of similar asset which gives you the right either to the profits or to the liquidation proceeds of that company in which you have made the investment would be treated as your ownership interest. The moment you hold any such investment which is not giving you any asset, any right to the profits or the liquidation, then it would not be treated as a ownership interest. For example, if you're having a debt instruments of that participation, it would not be treated as a participation interest. And the most important condition under this ownership interest is that you should be an economic owner, and you should not be only the mere legal owner or a person who is acting just as a nominee or an agent on behalf of some another person, and you are holding investment in that participation under that name. It may happen sometimes that the legal ownership is there with someone else, but the economic ownership of those shares lies with someone else. So the important criteria to understand is who is the economic owner of such ownership interest. So that's the first and most important condition with respect to the ownership interest. The another important condition says that you should have a minimum acquisition cost test. So the ownership test says that you should own at least 5% of the ownership interest into this participation exemption. Now, it may happen that these conditions, the minimum ownership test and the minimum acquisition cost test, are the OR condition. Either you own 5% of the ownership interest into the participation, or if you are unable to fulfill that condition, you may even have the acquisition cost of that participation up to 4 million dirhams. So if you are having the acquisition of more the acquisition cost of 4 million dirhams for an uninterrupted period of 12 months, then also you would be treated as satisfying this condition and you may be eligible, and the dividend income or other profit distribution derived from that company would not be taxable in your hands. So these two conditions are an OR condition which needs to be fulfilled, either 5% of the ownership or 4 million of the acquisition cost into the participation. The another important condition is holding period should be minimum 12 months. Now, holding period test says that whenever you are making an investment, you should have made that investment with the intention of holding a long-term interest or benefit into the participation where you are making the investment. The law says very clearly it may happen that we made, sometimes it is the intention, it is like a substance over form method that we should be utilizing when we need to test or identify if the holding period test is being satisfied or not. Even the intention of the person or intention of the company to hold or make an investment with the intention of long-term benefits to be availed out of those investment would be treated and would be considered as satisfied. So no need. It may happen that after 6 months, you made an intention, you made an investment with the intention to hold for 12 months, but due to some circumstances, if after 6 months or 8 months you dispose of those investment, it would be the intention that will be checked for ticking off if the condition is being satisfied or not. Going on to the another important condition, that is with respect to the minimum subject to tax test. Now, what does this condition imply? Now, it may happen that you are making an investment into a company which has a foreign tax rate which either may be less than 9% or more than 9%. Now, 9% is the standard tax rate that is being defined now in the UAE. How about my investment are made from long time, suppose say into BVI entities or Seychelles entity or even a US entity where I'm already paying a tax of 20% for the dividends they are distributing. So this condition is very simple and is being made with the intention that whatever dividend you are deriving, that dividend should already be tax paid in the country in which from which you are receiving this dividend from. So so it says very clearly that the participation or the company in which you have made the investment should either be subject to 9% tax or it is subject to foreign tax that is at least 9%. Now, it may happen like a countries like Seychelles or a countries like BVI or IOM, they do not have any tax rate. They are a 0% tax rate. So what do we do when we receive an income, when we receive a dividend or other profit distribution from such countries? In that case, we have to calculate an effective tax rate. Now, effective tax rate is, there are definitions, they have given some theoretical calculation that how would we derive the tax rate. Either it would be an actual tax rate or a theoretical effective tax rate. Now, actual tax rate would be actual tax that is being paid during the tax period divided by the profits before tax under the accounting standards of that respective country. If we are unable to derive this actual tax rate, then we will have to derive the theoretical effective tax rate. Suppose in a country like I am, 0% tax. How do we calculate it? We will recalculate the accounting net profits of that country based on the UACT and see what is the tax rate coming. Accordingly, we will determine, and if this conditions is not fulfilled, like if the country is not paying any taxes, then the dividend you will receive from those countries or other profit distributions you will be receiving from those companies would be taxable in your hands. So we have to be mindful while calculating that straightforward. Everyone is of the opinion that okay, foreign investment making more than 5% of the investment or more than 4 million, whatever income I will be deriving as an investment would not be taxable in the UAE. But this is one of the important conditions that we have to identify while determining if that income or that dividend income would be exempt or not. The important concept to understand under this the subject to tax test is if you're receiving any income, any dividend income from a qualifying free zone person or from an exempt persons or from a holding company or even the entities who are eligible to opt for a small business relief, this condition is deemed to be satisfied. Now this would come only in the case where capital gain is to be determined, because these are all only with respect to domestic company. So the moment you have an investment in QFZP or an exempt person or an holding company and you are receiving any dividend, or when you are disposing of that investment, capital gain would be deemed to be exempt, because it is deemed that these companies are already paying the taxes in UAE. The very last condition that needs to be satisfied with respect to the dividend income when deriving from a foreign company is with respect to this asset test. Now, what does this asset test says? So it says that being a participation, if I am the participation, I am the foreign company, my assets, my direct or my indirect assets needs to meet the definition of ownership interest. Now, what do you mean by ownership interest? As I explained earlier in the very first condition, that I should have these shares, which are the preferred shares, which are the equity shares or the redeemable shares. If my more those assets that is being held by me as a participation, that is a foreign company, the qualifying assets, that is these assets should be more than equal to 50% of my total assets. If my 50% of the total direct or indirect assets are into this qualifying ownership interest category, then it is deemed that whatever dividend I will be paying would be exempt in the hands of the person who is receiving such dividend or other profit distribution. Just to simplify and to elaborate this condition, because it is very crucial to understand and to determine how will we determine what is treated as a qualifying or a non-qualifying with respect to the company in which we are making the investment. So just to give you an example, say company B is being incorporated and is resident of the UAE, and it is holding 10% shares of company E, and it is being held outside UAE. Now it has the total assets of of company E as on 31st August 2024 and 31st October 2024 lies as belows. It has 100,000 dirhams of the total assets, and the investment which the company is being making consists of a qualifying and a non-qualifying ownership interest as 10,000 and 60,000 as on 31st August 2024 and 30,000 and 20,000 as on 31st October 2024. Now, while determining this direct and indirect asset consisting of the non-qualifying ownership interest, we will divide this non-qualifying interest by this total assets, which gives us a percentage of 60%. While as on 31st October, this non-qualifying interest is 20%. Now, company E, that is the participation foreign company, resolves and distributes a dividend as on 31st October 2024. Now, although we say that this asset test, that is more than 50% of this qualifying, more than 50% of the qualifying assets has exceeded at the time, when the dividend was distributed, has already exceeded the limit threshold of 50%, but the test was not fulfilled during the entire period. So we have to be also mindful that these all tests, which I have already explained earlier, needs to be fulfilled during the entire tax period, and it is not only at the time when the dividend is received. So fulfilling all these conditions is important for the entire period. In this case, as although it was fulfilled when the dividend was received, but as it was not fulfilled during the entire period, it would be assumed that the asset test has failed to meet, and therefore such dividend which is being received by company B would be taxable in its hands. So I hope it clarifies all the important conditions for receiving, when you are receiving any dividend or other profit distributions from your foreign company investment. Now, the last important criteria that would be treated as exempt income is if you are receiving any income, if you have a foreign permanent establishment, then you may apply to the authorities and mention that you want to claim an exemption with respect to whatever income your foreign P is deriving. So first you will have to make an application. If the application is accepted, then any income and expenses that is associated to your foreign PE would not be part of your taxable income while determining the UAE corporate taxable income as well as the liability. Any income and the associated expenses needs to be calculated as if the foreign permanent establishment had been resident in the UAE. So you'll have to do all the recalculations again, and those income and expenses then will be deducted while determining your taxable income. Lastly, the foreign tax credit whatever is available for the taxes which you have paid in the into the country where your permanent establishment is being there, you would not be able to claim that foreign tax credit. And the another important criteria is the exemption would be applicable only if the country in which your foreign permanent establishment is being located is levying a tax which is not less than 9%. So that tax rate has to be more than 9%. Of course, arm's length principle would definitely come as it is you and your foreign permanent establishment. So all these conditions if fulfilled all together, you make an application. If it is being satisfied, then your foreign permanent establishment's income and expenses would not be part of your taxable income, and you do not need to pay taxes. Although if you do not pay, then of course it will be taxable, and if it is taxable, any foreign tax credit that you have paid, that would be deductible while calculating your taxable income. So this was all with respect to the exempt income. I hope it clarified and gave you an idea about when your income with respect to dividend income, capital gains or other profit distributions would be exempt in your hands. Now we will like to have some poll questions to understand that the audience was attentive during the entire time. I would now hand over to Pratik sir to take the poll questions.
Thank you so much, Karishma. I think it was a very well articulated session, and I see a lot of participation in the Q&A as well. So let's start with the first poll question. So the first poll question is: Company X donated AED 20,000 to a local school. Is it a deductible expense for corporate tax law? 5 seconds. Excellent. Can we have the answers now?
Yeah, so 84% people have mentioned that no, it is a deductible expenses. It is a deductible expense. Answer no, and 16% still feel that yes, as it is for a business purpose, it would be an allowable expenditure. So I think Kinjal, if you can answer saying this question as you covered the expenses part, that would clarify the audience about their answer.
Sure, Karishma. So, as we discussed, if any donation, gifts, or grants are given to a qualifying public benefit entity, only in that case it would be deductible. A local school might not qualify to be a QPFBBE, and therefore it would not be deductible.
Sure. I'll share the next
Excellent.
question.
Yeah. Entertainment expenditure. So company X paid 2000 dirhams for flight tickets on behalf of a shareholder for business purposes. Is it deductible expense for corporate tax law? So if the session people would have heard it right, I think we would have right answers. So can we see the answers, Karishma?
Sure. So 13% people still feel that no, it would be allowed as 100% expenditure, but the right answer is yes, it would be restricted up to 50% of your actual expenditure, being it
Correct.
would be a part of your entertainment expenditure.
So in the law, they have specifically said that shareholder expenses has to be restricted to 50%, and therefore, unfortunately, the wishful 13% will not be eligible, to get 100%. So it is restricted to 50%, and I hope it clarifies the doubt. So moving ahead, vehicle expenditure. So company Z utilized car for business purposes. It had incurred a fine of 10,000 dirhams. Is it a deductible expenditure for corporate tax purposes? Yes, because the car is used for business purpose. No, because it is a fine imposed due to breach of law. Simple yet tricky. 5 more seconds. Excellent. Can we see what are the results, Karishma?
Yeah, so I think 18% people still feel that being the car is being used for the business purpose, they can claim this 10,000 as an allowable expenditure. Unfortunately, as already explained by Kinjal as well, that the fine, although it was used for business purpose, but as it is for imposed for a breach of law, it had it would be the breach of contract, then it would have been allowed an expenditure. Being a breach of law, you cannot claim this as a deductible expenditure.
Excellent. Can we move ahead? Interest expenditure. For a company A in financial year 2024, AED 15 million of net interest expenditure was disallowed since excess of 30% EBITDA. Is the expenditure deductible in future tax period? No. Yes, up to 10 years. 5 more seconds. Excellent. Can we see the results?
Yes, so 90% people have answered right. Yes, it can be carry forward and deductible up to 10 years. 10% people who feel that no, it would not be allowed. So you may allow it up to 10%. That is very
So
clearly
that's
given in the
good
law
news.
as well.
That's good news that it is allowable for 10 years and you can carry it
Correct.
forward for 10 years. Excellent. Moving ahead. Exempt income expenses. Company X only earns dividend from resident juridical person. Will expense incurred by it to earn such income be allowed? No, as expense is related to earning exempt income. Yes, only 50% is allowed. 5 more seconds. Excellent. Can we see the results?
Yes. 17% people feel that no, yes, only 50% would be allowed. And 83% people have answered that yes, as it is being related to exempt income, it would be not allowed. So
Excellent. So they
83%
are
people
right.
have chosen. Yeah.
So 17% people who still think that it will be allowed 50%. Unfortunately, it will not be allowed only because this is to earn the exempt income and dividend is being an exempt income, this expenditure you will not be able to claim. So Sorry, but those 17% have to, have to think again. But yeah, it shows a lot of active participation. So can we have the next poll? Yeah, thank you. Penalty expense. Company Z paid 10,000 dirhams penalty for missing the CT registration deadline. So very good. 31st May is approaching the last date for at least Jan and Feb issued licenses. Is it an allowable expenditure if you guys forget it and register late? 5 more seconds. Can we have the answers, please?
15% who still feel that if they miss the deadline and they pay the 10,000 dirhams would be an allowable expenditure. So unfortunately, it won't be, being it is a breach of law. It would not be
Correct.
an allowed expenditure. It would be disallowed. So please register yourself before 31st May. And at least for the licenses who are issued in the month of Jan and Feb and who are having POEM in the UAE, for them the deadline is 31st May. Do register before that and avoid this penalty of 10,000.
Correct. Moving on to next. So bad debts. Will the provisioning for bad and doubtful debts be allowed as a deduction? Yes, no. Three more seconds. Excellent. Can we have the results?
So 42% feel that no, it would not be allowed, while 58% have answered it correctly that yes, it would be allowed. Bad debts provisioning for bad debts, as I think already Kinjal has mentioned, that your books and your accounting profits and loss will be determined as per the IFRS principles. And IFRS nowhere mentions that any bad debts provisionings that you would be made, it would not be an allowable. It is your book profit, is part of your book profits, and being any provision made for bad debts, if it is a provision made, it would be allowed. If it is recovered, of course it would be treated as an income. So it works
Correct.
like that.
Correct. Moving ahead, we have one more, right?
Two more.
Excellent.
Actually, three more.
Okay. So will dividends received by Mr. X, a natural person from ABC LLC, a UAE entity, be subject to taxation? Yes, no. I hope we get 100% in this.
I can see some deviation though.
Ah, 3 more seconds. Can we have the results?
So 14% people still feel that this dividend income, if they are having this dividend income, it will be subject to taxation. So I think it's a good news for you that this dividend income as an individual, if you're receiving, it would not be taxable. As I explained, for a natural person, if you are deriving as a business income and if it is exceeding 1 million, then it will be treated as your taxable income, but it is an exempt income. And even if it is you are not receiving as a business income and not exceeding 1 million, then it is your personal investment income. So in either cases, it's a win-win situation for you.
Correct. Thank you so much for providing the clarity, Karishma. Can we move to the next one?
Yes.
Capital gains. Wow, interesting one. Well, capital gains earned by XYZ LLC from selling shares of ABC Free Zone Company, a UAE entity, be exempt from taxation. Only if participation criteria are satisfied, will be exempted in any case. 5 more seconds. Excellent. Can we see the results?
So 67% of the audience is correct. Yes, only if the participation criteria, those 6 conditions are being satisfied, then your capital gains, even from your domestic company that you are receiving, would be exempt. If those are not satisfied, then capital gain would be taxable. So 33% who still feel that it will be exempted in any case, unfortunately, it's not right. You have to fulfill all the conditions, then and then only that capital gains would be exempt in your hands.
Correct.
Last question.
Documentation. Is proper documentation required to be maintained for investments if you want to avail participation exemption? Yes, no. Five more seconds.
At least I hope this would be giving 100% yes, but still
Arish?
2% people just feel that no, there is no documentation required. So I think, Kinjal, if you want to answer this question, as you already mentioned earlier as well, that there needs to be a proper documentation in any case. You're on mute, Kinjal.
That's right, Karishma. Documentation is required.
Okay, so yeah,
So
with
yeah,
this all
documentation is
the
also important now that
correct.
because we have moved into a UAE corporate tax era, and without proper documentations, if the FTA ask us for providing the supporting, then if we do not produce it, there is a possibility that we may not get those benefits. So therefore, that documentation is very critical and important. Also, I have been seeing the Q&A, and there are a lot of questions, mostly all repetitive. So I'll just clarify, and probably Karishma and Kinjal, you guys can add. One is on the clarity of entertainment expenditure. So entertainment expenditure slide, if you can pull off, uh, you know, law has defined that certain expenditure is allowed only up to the tune of 50% because it is not only done for the business purposes. Hence, you need to understand that it is restricted to 50%. For example, any expense for shareholders, right, is or any recreation or amusement activities is not 100% allowed. It has to be restricted to 50%. Only and only if it is for your employees, these meals, amusement, then it is 100% deductible because it is in the nature of business. Otherwise, it is restricted to 50%. So I hope that clarifies that expenditure on entertainment for any clients, any partners, any suppliers, any shareholders, any customers, which falls in the category of entertainment. And that is why it is very important as per the audit as well, that we do not classify this as an business expenditure. We have to classify it, scrutinize it specifically as entertainment and deduct only 50% as the allowable expenditure. The second question that I've seen is, surrounding whether the salaries will be, allowable or not allowable. So salaries in case of sole establishment, I think Karishma has touched that upon, and Kinjal also threw some light. So in case of sole establishment, it is not allowed. But apart from that, in LLC, whether in free zone or mainland, it doesn't matter. If it is a limited liability company, and if that is a remuneration paid, it is a deductible expenditure because without that, business is not possible. Even if the partners who are, the shareholders of the company are relatives, are family members, it doesn't matter, right? What matters is because of them, there is business in that entity, and because of that, that becomes a business allowable deduction. However, in a sole proprietor, right, it is not allowed specifically because it is one person, and if he takes the salary, say he's earning 1 million dirhams or 2 million dirhams or 3 million dirhams, and if he wipes off all the 3 million dirhams as salary, for which anyway you'll have to get a transfer pricing done, benchmarking done. So in a sole establishment, it is not allowed. However, in an LLC, it is allowed. So I hope that answers maximum of the questions that was there. Uh, Also, what is important to understand is, uh, you know, I think Ravi has asked few questions on residency when it comes to UAE law. So I do not understand that question, but Ravi, if you can write that question over an email to us with right facts, we'll be happy to answer that in detail. Again, questions regarding what if the shareholder withdraws a salary in an LLC company? If a director goes on a business trip, then expenditure should be allowed as it is not entertainment. And Ganpat, when you write director, in bracket shareholders, I hope you understand these are two different people, right? Directors and shareholders are different. Directors growing to a business trip is a very separate matter, and obviously it is allowed, but shareholders, no, it is not allowed. So I hope that it clarifies. I've tried to cover everything except some questions which I'm not clear specifically. Can you please explain in detail the loan agreement entered between 9 December 2022? I mean, what has to be clarified? Unfortunately, I've not been able to understand here. But again, I think Karishma has put up the email IDs on the chat box. Happy to help you guys wherever possible. Happy to even have a call with you to make you understand, on few things. Karishma has done a lot of 15 minutes pep talks for corporate tax with a lot of, potential clients as well as colleagues who need any clarification. So we are happy to do that. Uh, if there are any questions, please write to us and we'll be happy to answer. I hope I've covered maximum of the Q&A. If not, please forgive me, but happy to, answer it if we receive the emails. Thank you so much, Kinjal and Karishma. That was a wonderful session, and I hope the audience loved it too. Stay tuned for our next webinar. We are planning something very unique this time, and look forward to having you in June as well with us. Thank you so much, guys.
Thank you. Thank you so much, everyone.
Thank you.